already know what our statement of comprehensive income is. We need to make profit. We need to record profit. So as business owners, as managers that have to run the day-to-day activity of the business, they need to be able to analyze how the profit is made and how the profit is not made if they are running at a loss. So we get to know now. They said, the statement of comprehensive income shows business owners and managers the amount of profit made by a business in a financial year. However, the information contained in the statement might be used to help to make some important decisions. Some examples are outlined below. So, what are the importance of having a statement of comprehensive income? Number one, investment decision. A business might use the statement of comprehensive income to decide how much money to invest in the business. For example, the statement shows that profits are rising. This might encourage decision makers to use more funds for investment. So, the first point about statement of comprehensive income is about investment decisions. If the business is making huge profit, so that might encourage the owners of the business to invest more to make more profit. Do we get it?
Yes.
And if it's the other way around, if the business is not making profit, that might discourage the owners of the business to stop putting so much money into the business. Do you understand the investment decision here? Yeah. It's about funding the business, to put more money into the business or not to put. Is it clear? The second one, cost analysis. The statement of comprehensive income will show that what has happened to cost during the year. It might show, for example, that the cost of sales has increased sharply. As a result, the business can identify reasons for this and take measures to bring costs under control. A business might decide that cheaper suppliers of raw materials must be found, or that the wage of production workers must be brought under control. So, cost incurred into the business, which could be as a result of resources used, which can also be as a result of the amount you have to pay to your workers. So if you are incurring more cost, if your cost is rising, it allows you to be able to decide, because you'll be able to know if you are not making much profit, you would know the amount of cost you made last year compared to this year, because it is recorded. So if the cost you are incurring this year is increasing, then you should start finding a way to cut the cost, either through expenses or through wages you pay to your supplier, to your customers, or to your workers. Or you start thinking about finding cheaper supplies. It might be as a result of the amount you pay on supplies. Do you get the point you're making here?
Yes.
If your cost, you have to analyze your cost. How do you analyze your cost? You analyze your cost based on how it's increasing or decreasing. If your cost is increasing compared to last year, then you have to understand why it's increasing. What aspects of the business is incurring more cost? Is it the amount of wages you are paying to your workers? Is it the suppliers you are using? If it's based on the suppliers, then you start to think about finding cheaper supplies to reduce your cost. Is it clear?
Yes.
That's cost analysis. The third one, basis for future prediction or forecast. Many businesses like to forecast the future performance of a business. Most public limited companies are expected to give shareholders some idea of what earnings to expect in the future. Businesses can therefore use the statement of comprehensive income as the basis of which to make forecasts. For example, if profit for the year has increased by 5%, a business might tell shareholders that next year earnings are expected to rise by 7% if the economy continues to improve. So, basis for future forecast. If your profit for this year has increased by the amount they said, like 5%, it allows you to be able to confidently tell your shareholders that in the annual general meeting, the AGM, that next year's profit will increase by 7%, in as much as all things are equal and the economy is improving. So you can logically tell your shareholders that. But if your profit is falling, or if your profit fell compared to last year, then you can alert the shareholders that things are not moving fine. Oh, the economy is not moving fine. Then you can be able to tell them why it is like that. So your statement of comprehensive income will state the profit made by the business compared to last year. So if it is improving, that means shareholders should be expecting more dividends the next financial year. Do we understand basis for future forecast here?
Yes.
It allows you to be able to predict the kind of profit you are expecting in the future. Making comparisons. Investors may use the statement of comprehensive income when deciding where to invest their funds. For example, if a financial institution was looking to invest some money in the motor car industry, it might look at the statement of different car manufacturers to help decide which one looks the most attractive. The use of statement of comprehensive income for assessing the performance of a business is discussed further. So you can use it to compare. If you want to invest as a business, as an investor, if you want to invest in a business, you can use the statement of comprehensive income of 2 or more businesses to see which business is more profitable. Which firm is making more profit than another. So company A, company B, company C have come up with a proposal. They gave you a proposal that they want you to invest in their company. So in as much as they are in the same industry, you could use their statement of comprehensive income to compare which one will be more profitable in terms of your return on investment. Do you get the point here? So comparing business A, business B, and C with its comprehensive income, you'll be able to know which one is making more profit. That will allow you to choose which one you want to really invest on. Is it clear? Any questions about that? No. Move on, please. The nature and importance of profit. Profit is basically the return on investment. That is what profit is. So why is profit important to a business? Because profit is a driving force in most businesses. There are few, if any, which attach no importance to profit. The exception perhaps being charities. So the only business that would, it's a charity that doesn't care about profit. Most businesses are set up because they want to maximize or they want to make profit. So, profit has a number of functions. It is the prospect of making a profit that motivates many people to set up a business. So, all businesses, most of the businesses are set up as a result of making profit. Without profit, there will be little incentive for individuals to waste their time and money. If profit is not ascertained, if profit is not certain, there's no point putting my hard-earned money into it, my life savings into it. I would not want to do that because it's not profitable. That is the point they are making here. Do we get it? Yes. Do we get it, guys?
Yes.
Economists often refer to normal profit. This is the minimum financial reward an entrepreneur must receive in order to maintain interest in the business. So we call it normal profit because it's the minimum of your return on investment. Without that, you might not be able to continue the business. That's the normal profit. The minimum amount you can make because you have risked setting up the business. So what you could make to make you to continue, to give you the incentive to continue that business is your normal profit. Do you understand what normal profit is? If a business does not earn this amount, an owner will pull out. If you can't even make a normal profit, then what's the point continuing the business? You pull out, you stop. Profit levels affect the flow of money into and out of different industries. Money will flow into expanding industries where profits are rising and out of declining industries where profits are falling. So the point here is that if profit is increasing, the industries will continue to rise. A lot of businesses will come into the industry. But if in the industry profit is falling, the industry will decline. A lot of businesses will pull out of that industry. If the educational industry is no more profitable, a lot of schools will go back. But if the educational industry is profitable, a lot of schools will come into the industry. That is the point here.